Hello, Anthony Sicaro here, founder and president of Providence Financial and Insurance Services, located in the heart of the San Fernando Valley in Woodland Hills, California. I'm also an estate planning attorney and host of the Providence Financial Retirement Show, which airs every Saturday on AM 870. KRL Lays the Answer. And periodically, I like to do videos for my clients to bring you and get you up to speed with what's going on in the economic environment and how it affects you, my clients. And if you're a client of ours, thank you for your business. Thank you for your trust. You know I don't take it lightly. And I guess I should be the first one to offer you a congratulations. And I know you might be thinking, well, what for? Congratulations. Well, congratulations, because today, about 3 hours ago, I'm recording this on Monday, June 13th, about 3 hours ago, the stock market officially entered bear market territory. So, congratulations. Why congratulations? Because we have you prepared for this. We know that this is going to come. It wasn't a matter of if, it was just a matter of when. We know it's going to come, and all of you are prepared because you're all invested for income. So the reality is that whether you're taking your income or whether you're reinvesting your income, you are going to be just fine. Because if you're taking your income doesn't change even though your portfolio fluctuates. And if you are reinvesting your income, because the portfolio's fluctuated down, you now get a discount on the interest and dividends that you have to reinvest. Both of those are congratulatory. Both of those are worth taking a moment to say, I'm glad I'm invested for income, because you're going to still be able to count on your income. And if you're reinvesting your income, you actually get a discount. So just a brief reminder. Now, there are 4 things I want to cover in the rest of this video. The first thing I want to talk about is risk versus volatility. The second thing I wanted to answer, the second question that I want to answer is, should I sell? Market's down 20%. Should I sell? The third thing I want to talk about is timing the market. And the fourth thing I want to answer, the fourth question I want to answer is, should I buy? So it's interesting dynamic. Let's talk about risk versus volatility. Risk is the ability to lose something. Volatility is just the fluctuation. Risk is permanent, volatility is temporary. The only way you're going to lose the money in your portfolio is if you sell at a loss, or if something in your portfolio goes bankrupt. And you know that we have you extremely diversified. If you take a look at your portfolio, you've got less than 1% in most of your investments, and there might be a few that you have 2 or 3% in, but the reality is you're extremely diversified. If something were to go bankrupt in your portfolio, and we've never had that happen, but if that did happen, maybe you lose 3 to 6 months of interest. It's not going to wreck your retirement. Your retirement is not dependent on any one investment. So you're extremely diversified. And so the reality is that when we look at the risk, diversification and research mitigates risk. We do the best research I'm going to suggest of any money managers out there. Our guys are top notch. And the reality is we do a ton of research, and you are extremely diversified. So the risk of you losing money is really just going to come down to whether you sell at the wrong time. So that's risk. Volatility is just temporary. We know nothing's going to go up forever. Fixed income's not going to go up forever. Of course, lately it's been going down. It's not going to go down forever either, right? The 10-year treasury is not going to go up forever. Interest rate's not going to go up forever. Those things are going up now. The 10-year treasury, oh my gosh, it went up to 3.35 today. Last I looked at it, might have gone a little higher than that. That's what is affecting your income portfolios more than anything else, is the rise of the 10-year treasury. That's affecting your fixed income, but that's not going to go up forever. So it's just fluctuation is the temporary changes of asset value. That's what fluctuation is. It's not going to go down forever. It's not going to go up forever. As a matter of fact, when the stock market has an earthquake, and today, market down, I think it was 900 points or somewhere in that range, entered official bear market territory. What tends to happen is things tend to overreact. Even the fixed income investments tend to overreact a little bit. And that means that when they land hard, and then they tend to bounce back a little bit. So the fact is that this is exactly what's happened. There's a lot going on in the financial world. If you're investing for income, if you're living off the income, don't worry about it. You're still going to get your income. If you're reinvesting the income, what you want to hope is that maybe it stays down here for a little while. Maybe it even goes further, because you get a greater discount every time you reinvest. So I think it's important to understand the difference between risk and volatility. Risk is a permanent loss. And volatility is just a temporary fluctuation of asset value. So it's important to understand. So I wanted to talk about that. Let's answer the question, should I sell? The answer is it depends. If you are thinking about taking some chips off the table, and readjusting your allocation for the future, then it's not a bad time to do that. Okay. It's not a bad time to shore up your portfolio in preparation for retirement or in preparation for some turbulent years coming up if you're already retired. The reality is that the market has gained, check this out, 70% in the last 3 years. 70%, the S&P 500, and it's down 20. You're up 50%. You don't want to sweat in the fact that, the market's down by 20%. Oh my gosh, I lost money. You're never going to get out of the top unless you are just purely lucky. You're still up 50%. And I'm talking about if you were fully invested and you mirrored the S&P 500, you're still up 50% over the course of the last 3 years. Don't be afraid to take some chips off the table. And what I don't want you thinking is, oh, I got to wait to get it back. That's like putting money in the slot machine in Las Vegas and losing $100 and keep putting the money in. You got to get your $100 back. Does that ever work out? It doesn't. It's the same thing. We have a lot of volatility ahead. The reality is your market's down 20%. If you've been invested in stocks, you've got a bunch of stocks for the last decade or two, you've done really well. If you're, now within 10 years of retirement or you're retired, not a bad time to take some chips off the table. So I'd recommend selling. And every one of you is different. So I can't say recommend to get down to 20% or 40%. Every one of you is different. If you've been thinking about taking some chips off the table, call me. More than happy to talk to you about what's that look like for you. But let's go to the other scenario. And the other scenario is, some of you might be thinking about taking chips off the table so you can buy back in at a lower price. And the question is, should you do that? And the answer is no, a resounding no. That's called market timing, where you're trying to buy, you're trying to sell and then wait for it to go down and then come back and try to sell at the high and wait. That's market timing. That's extremely dangerous, because what happens is you're going to miss big run-ups because volatile downward markets, bear markets, are often followed by bull markets. And it's extremely important to understand what happens if you miss out on some of the best days that the market has. I want to give you an example. I was doing some research just recently, and Putnam, these numbers are eye-opening. Putnam put out basically a chart. And it shows if you would have invested $10,000 15 years ago and left it in, what would have happened? Well, your $10,000 15 years ago and you would have left it in, it would have turned into $45,682. Okay, $10,000 15 years ago would have turned into $45,682 as long as you let it sit there. That's a 10.66% rate of return on the market. Not bad. But what if you'd have tried to time the market? And what if you'd have tried to buy low and sell high? What if you would have missed the 10 best days in the market? 10 best days in the market over the last 15 years. You would not have grown your $10,000 to $45,000. You would have grown your $10,000 to $21,000. So there's a significant loss, $24,000 difference by missing the 10 best days in the market. So instead of having a 10.6% rate of return, your rate of return would have been just a little over 5% by missing the 10 best days. What if you'd have missed the 20 best days? Well, then you'd have turned your $10,000 into $12,000. And your rate of return wouldn't have been 10.6 per year. It would have been 1.6 per year. What if you missed the 30 best days in the market over that 15-year time period? All you did was miss the 30 best days. Well, then congratulations. You turned your $10,000 into $8,300. You actually lost $1,700. You had a negative 1.18% per year. And what if you missed the 40 best days of the 15 years, that 15-year period? Guess what? You would have almost cut your $10,000 in half. You would have lost 43% of your portfolio just by missing out the 40 best days. People that try to time the market are often wrong. You can't time the market with precision. If you could time the market 100%, get out at the top, 100% buy at the bottom, you'd be better off. You just can't do that. It's not possible. Even the professionals have said that it's not possible. Warren Buffett doesn't try to do that. And Warren Buffett said something that I recently read. You know that I like a lot of his quotes. I think he makes a lot of sense. I hadn't read this quote before. Warren Buffett said, when stocks are down, don't watch the market closely. That's his solution. I'm going to suggest it's the same thing with fixed income. Don't panic over it. We don't like to see our account balances down, but the reality is it's a part of investing, and we know it's coming. We knew it was coming. You've seen me do live TV interviews about it. You and I have talked about it. You've heard me do podcasts about it. This is not new. If it's not new and we knew it was coming, there's no reason to panic. And by the way, I'm talking to those of you that might be a little nervous. I have to tell you, I'm proud of all you guys. The reality is we've gotten no phone calls. Literally, I don't think I've had 2 or 3 people send me emails with some questions, but no one's panicking. And I think the reason you're not panicking is because you're prepared, because you know that we have a plan. You know you're invested for income. Everything we're talking about now is just a recap of what we talked about before. And I'm just giving you a little insight as to the fact that the market went into bear territory, which for you doesn't matter. If you're reinvesting, it helps you, not a big deal. But you're going to read headlines. I've gotten headline after headline on my phone. Bear territory. What is an investor supposed to do? Stay put. That's what you do. Not a big deal if you're a client of ours. So I think I think it's important to understand. So should I sell? If you're thinking about shoring up, if you've got 60 or 80% of your money in stocks and you're going to be retiring soon, or if you are retired, absolutely. I think that's too much, especially if you've already got enough money to last you the rest of your life without having to worry about taking the risk. Yes, you probably want to sell to reduce your exposure depending on your situation. Call me, we'll talk about it. But if you're selling just to think about buying lower, don't think about it. Don't do it. Just sit tight. So that answers the second question. We talked about risk volatility. The question is, should I sell? We talked about timing the market. I kind of built that in to our conversation. You don't want to time the market. And the last question that I want to answer that some of you are thinking, and some of you have asked me, a couple of you, is should I buy? And that's a better question. That means we're not panicking. That means we're preparing. And the market is at 20% discount right now. I have put out videos before when the market was down 10% and 15%, suggesting that it may be a good time to get some money in the market. If you did not get any in the market at that point and you have no money in the market at all now, then I'm going to suggest that you either stay that way, and everyone's situation is different, or you get some money in, maybe a small percentage. Now, if our plan, and we've met before in the past, we said, look, you don't need to have any money in the market at all, then just stay with that plan. On the other hand, we do have a 20% discount on the market, and if you've been thinking about putting a little in the market, or if our plan was maybe to take a little bit, maybe 10 to 30% and put it in the market, I think now's a good time to do that. So if you have no money in the market at all, absolutely, I'd encourage you to call me so we can get some money in the market. We're at a 20% discount. So that's the first thing. Now, what if you already have 20 or 30 or 40% in the market? A lot of you do. Well, what I don't want you to do is I don't think we're at the point where I'm going to say, put it all in at this point. And when I say all, I don't mean your entire portfolio. Most of you, we're never going to do that with. But when I say all, what I mean is the maximum amount that we've kind of prescribed as you being in the market. So for example, let's say that, out of your portfolio, we've decided that, we want to put $500,000 in the market. So what I'm talking about is I wouldn't want to put that all in the market. Now, 20% of a discount is not a big enough discount for me. Maybe if you want to put $500,000 in the market, 20% discount might be good enough to put 40 or 50% in at this point. So if you've only got 30% in the market now, out of 500,000, maybe you've only got 200,000 in the market. That's 40%. Yes, I think maybe you could add another $100,000 to that. And so I think if you have a number as to like what's the maximum amount you want to have in the market, right now it's probably a good time to maybe put half of that amount. Okay, half of that amount. Because I still think we have some downward pressure on the market. Now, you might ask, well, if the market's going to go down, why don't I just wait? Because the market may not go down anymore. What if we're at a bottom? What if we hit the bear market and tomorrow the market's up by 1,000 points and then it just goes up from there, and next thing you know, it's only down by 13%, not 20, and you missed out on 7% just like that. So we don't know that that's going to happen. I don't expect that's going to happen, but it could. We've seen it before. So I think at this point in time, most of you that have some money in the market, is not a bad idea to add some more. But we're not going to do that without you. We're not going to do that without having a conversation. If you want to add more to the market, call me. And whenever I put out a video like this and ask you to call me, you guys are very good about calling me. So be patient. I will find a way to call you in the evening. A lot of times in my evenings, I spend time studying in the jacuzzi at my house. Don't be offended if I call you at 8 o'clock at night. We could get that question answered, because if I get a lot of calls, I got to find a way to answer that. I may call you on my way home from work. I may call you on my way to from work, or my way to work, in the office. So I'll find a way to call you. If you want to have a conversation about should you add more stocks to your portfolio, call me. You have the number 818-887-6443. So we talked about risk versus volatility. We answered the question, should I sell? We talked about timing the market, why that's dangerous. I give you some specific numbers. And now we've talked about, should I buy? I actually think it's a good buying opportunity, but I also wouldn't go all in. Forgive me as I check my notes real quick. I've jotted down some things. I want to make sure that I'm not missing anything for you. See if there's anything we wanted to talk about. I think we talked about that. And I think we talked about that. That's going to do it. Again, call me 818-887-6443. If you're a client, thank you for your trust. Thank you for your business. Don't be afraid to share this video with your friends. And don't be afraid to watch my podcast, or you don't watch a podcast, you listen to the podcast. There's a lot of good stuff there. We've talked about this. My next couple of shows talk about this volatility in more detail. You're going to want to watch them. You can go to providencefinancialpodcast.com, just right to your webpage, and listen to it right on your computer. Or if you have a podcast player on your phone, you can just search for the Providence Financial Retirement Show on your favorite podcast player, and we will come right up. Listen to the show. Please share it with friends, and hope this helps. God bless.